Gold is at risk, so the headlines say, but what is it that we're really at risk of? So let's start with the confusing words again, some double negatives maybe. Good news is bad for gold. No bad news, also bad for gold. But bad means price drops, so bad news for gold, well, that's good as far as I'm concerned. At least for now. So if I say gold is at risk of falling below current support, something I've mentioned in the past few videos, I don't think that's a bad thing. I'm all for spot price cooling off for a while. The confusion only comes in when we use trader lingo for physical holdings. If you intend to hold an asset for a long period of time, well, you'd rather pay less for it in the beginning. So let's do a quick look at what gold is actually at risk of. Before we get back to it, if you're looking for precious metals, hit up SD Bullion. New customers even get gold and silver for spot. It's sdbullion.com/new. So let's start out with the lack of bad news. We're going to skip over the mutiny that wasn't in Russia and look at what the Federal Reserve is up to. Now, they run an annual stress test on large banks. Maybe you knew about this. It normally wouldn't be newsworthy, though. This is just a simple case of addressing the 23 large elephants in the room. And the Fed says that each of those large banks, well, they passed with flying colors. So everything's fine. We're past any meaningful shocks, whatever. But what it does mean to the spot price of gold is simply that that particular risk is no longer priced in. The next thing putting the price of gold at risk is the threat of 2 more rate hikes. Now, Jerome Powell said that raising rates is not off the table. 2 or more rate hikes, they're being projected. And the CME FedWatch tool, that's a gauge of trader sentiment, that's signaling a 90% chance of a 25 basis point rate hike in July. Now, Powell mentioned the chance of inflation becoming entrenched. He mentioned that would happen if it's allowed to continue to run. And this gets into 2 related ideas that have a really big impact on the price of gold. The first is this simple idea that rate hikes punch down the price of gold. They prop up the US dollar, they increase bond yields and savings rates, and that pushes gold price down. We know that part, we've seen it. The second part is this idea of inflation becoming entrenched, and to some degree it already is. The simple scenario of all prices increasing through year-over-year inflation, that increases the price in everything, gold included. Now, most of us would agree that that's already happened. All of us can see it, but we're talking about Fed lingo here. And the Fed is saying that they're working to prevent it. That keeps the hope alive that it isn't happening, and that keeps the price of gold down. And it isn't just the U.S. central bank policy in play. You've got the ECB and the Bank of England. They're running pretty hawkish too. And all that talk about raising rates, it keeps the futures trading down. So what's down? Well, $1,900, that seems to be the support line for gold. If you ask a technical analyst, they're going to have a specific number. And to a certain extent, they're probably correct because buy and sell orders, they exist out there. They're set around those specific numbers. But what we're looking at here is a pretty powerful psychological number. Each $100 increment, that's a barrier. So we have tension in either direction at $1,800, at $1,900, at $2,000. That last one, that's even more. And once you break the barrier, well, the push continues faster in the direction that it was heading. So now if we see a close below $1,900, I'm going to expect $1,850 will follow shortly after. That's the gold at risk headline. If gold falls below that $1,900 support, it's at risk of falling further. Or to put it another way, get ready for a sale. About those premiums though, from a dealer perspective, they have a risk. Their risk is that they have inventory that they've purchased at higher spot prices, and that inventory really needs to cycle out before they can operate at normal profit levels. I mean, they're a business. So I see a lot of comments. They say the premiums just increase to balance out the price drops. To a certain extent, that's true, but only to a certain extent. A dealer can lower premiums on an uptrend for spot price. They may need to raise them on a downtrend, but really you need to factor in demand. So if spot price is going up and demand is still high, which is kind of what happens, spot price runs up, people rush in to buy, why would the dealer cut the premium? They already have the demand. And if spot price is going down, demand is low, well, then it's a harder call. But either way, eventually the inventory cycles through and premiums normalize. So you might not catch the best of both of those worlds, premium and spot price, if the spot price just drops for a single day, but that's not really what we're talking about here. So over the slightly longer term, the big question is whether that recession label ever gets applied. Now, I've seen analysts note that if the US avoids a recession, the price of gold could get stuck below $2,000 an ounce. But that isn't what most analysts are expecting. Most are expecting a recession. Personally, who knows? I'm not even sure what I expect. We just saw Q1 get revised. Turns out the economy was better than expected. Congratulations. Home sales are up, new car sales are up, confidence is up. Everything is coming up aces, at least in the reports. So back to the risk. Gold lost 2.7% on spot price this month. That's what we're looking at. But we're comparing that to May, a month where we saw gold almost notch a new all-time high. It pushed 2,063. Now, maybe we're going to fall further. All this talk about risk, though, does not feel that dramatic. I made two purchases. I just made one at 19.19 and then followed up with one at 18.92. So no complaints for me. If we do hit 18.50, I'll probably jump in. I'm going to buy more. Longer term, if we were to get stuck below $2,000 for a little while, well, that would not hurt my feelings either. I think it's a good time to be buying, and I'd rather buy at 18.50 than at 20.63. So let's call it good there. I don't think there's a whole lot more to say about gold being a risk. I will take the risk of a sale any day, but let us know what you think. Are you buying? Are you waiting? Are you selling? Let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you'd like to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.